This is the CRE Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Melissa Lewis with our experts Manus, Clancy, and Dianne Crocker. It's been another week of volatility in the stock market. Bond yields were all over the place, and for borrowers, the pain is starting to grow. We're 2 weeks in the war with Iran. Oil prices are surging. We had a Fed meeting this week. Lots of ground to cover today, Manus. Let's dive right in.
Well, it is March Madness week. 2 days full of nonstop basketball, which I love. It's always one of my favorite times of the year. So I'll start with that is the one high note we could point to today. It is a terrific couple of days for people that really love their college basketball like I do. After that, I think it's also March Madness, but in a series of negative ways. That all we saw this week was markets spiraling. It felt like chaos. And as of this morning, Thursday, March 19th, I think that there's more chaos on the way. So let's really take it from the top. The war in Iran continues to extend. People were hoping for an in and out for the war to span only a couple of days. Now we are in the middle of March, and there doesn't seem to be an imminent end. The fallout has been, we've seen volatility in the equity markets. Yesterday, big sell-off. Today, this morning, the futures are looking deeply negative. Bond yields, as you mentioned, all over the place as well. At the end of February, the 10-year was at 397. This morning, the last I looked, we were at 431. So we're about 32, 34, 35 basis points above where we were in late February. That translates into one for one a higher level of borrowing costs for anybody in the CRE market. There's no debating that. In addition, because of the PE issues we've seen and the concerns about PE losses on the corporate side, funds gating, some positions being marked down to zero by some of the operators, that we've seen risk premiums widen. As of about 3 or 4 days ago, CMBS spreads at the top of the stack were wider by 15 basis points. Down the stack in the triple B minus, it was 50 to 75 basis points. When you blend that together, the average risk premium is out 30 basis points or so on top of the higher Treasury rate. So for CRE borrowers, we are now 60 to 75 basis points higher in borrowing costs than we were 3 weeks ago. Not the direction we want to be headed. And on the data front, we've seen nothing really but disappointing news. We saw a really, really tough PPI print yesterday. The PPI number severely higher than expectations. Maybe that's not a surprise because oil prices are shooting higher. I'm not sure what the lag is between when oil prices go up and when it's reflected in PPI, but there's no doubt that that PPI number was ugly. And we saw late last week U.S. GDP cut in half from what was about 1.7 to about 0.8. So all of the winds are facing us head on right now, and it's tough to find reasons for optimism currently with the war in Iran going and with the PE problems still lingering.
Well, you started out positive there, man. It's got me all excited about March Madness. But you're right. I think we're starting to see certainly some early signs of stress that are forming across multiple parts of the market. And you just did a perfect job of highlighting the areas to watch. You mentioned, the 10-year numbers, the wider CMBS spreads. Those are all telling the story right now. We're seeing a risk equation that's really shifting palpably. And if you're a borrower, it's not so good news. You mentioned, there's a higher price tag for debt capital, and it's a lot higher than just a few weeks ago, and that's not trivial. I do want to go back to what you said about gating, because that's something that I think is really worth paying attention to. This unease around private credit, we're looking at potentially higher defaults, we're looking at sell-offs in the equities market, and questions around valuations. And I think, even if gating is a rational strategy. It's a red flag for the market, I think, of rising risk, because what happens when these gating statements come out, investors start thinking, well, what do they know that I don't? And should I be getting my money out too? And the danger, we all start worrying about is, what if there's a broader risk off behavior where banks and other lenders start to kind of pull their horns in just at a time when they were starting to re-engage. And Manus, we haven't even talked about Fed Wednesday. The Fed meeting this week, guess what? It played out exactly like everybody knew it would. The takeaway is rates are staying where they are. The Fed left the door open to cuts, but I think with what's happening with oil prices, it's a much narrower door than it was even a few weeks ago. They had the impact of tariffs on rising prices last year, and now the Fed's dealing with this, the high energy prices from the war in Iran that are threatening to prolong this inflation fight. And the high PPI report that you just mentioned, that was the first evidence of it, but it doesn't even reflect the impacts of the war yet because it was for February. So, bottom line is rates are staying put for the time being. And I think forecasters can get out their magic 8 balls or their dartboards or whatever they use to forecast, because any forecasts that were made at New Year's are now obsolete. And kind of two really broad forecasts in terms of how I see this playing out. Oil prices, they could retreat if the conflict is contained, if it's short-lived, as we all hope, or it could escalate if oil prices surge farther and longer and threaten both higher inflation and weaker economic growth at the same time. So there is certainly a lot to watch this week.
There is a lot to watch, and you bring up many, many important points there. Maybe we'll peel back a couple of them. The first, I would say, is I did paint a gloom and doom picture in the first couple of moments about higher interest rates, higher risk premiums, a volatile stock market. But as we saw in April, these things can turn on a dime. In April, the president and his administration took tariffs off the table to some degree. They said there'll be a timeout, there'll be a gradual phasing in. We'll have a 90-day window for people to negotiate and so forth. And the markets really took off from there. So it's very eager to feel all this negativity today, but it's important to point out that it could turn on a dime. That being said, I want to go back to April, and I want to talk about the reaction then and the potential reaction now, and get your thoughts on this, Dianne. In April, the consensus was higher tariffs were going to drive U.S. consumer good prices higher. That might trigger a recession. It would certainly trigger higher CPI. That didn't really come to pass. But through it all, the CRE market remained pretty much immune. I would say it wasn't even a speed bump for the CRE market in terms of transaction activity, lending activity. The Lightbox CRE activity index remained elevated. The CRE market just whistled past that issue. We're in a different one now, and the expectations are somewhat the same. We're going to see higher CPI prints. We're going to see higher costs to people, that perhaps those higher costs will trigger a recession. In that regard, it's similar to the tariff window, but something tells me that the CRE market will be slower to whistle by this one than they were in April. That stiff upper lip we saw 9 months ago may not persist. What are your thoughts there?
Well, I'm glad that you brought up last April, Manus, because I've had that on my brain this week too. There are similarities to the tariff wars kicking off last April, and now we've got the war, which has really increased the range of plausible outcomes for the economy with no clear directions. But it's weird because we have this strange tension between the CRE metrics that we track at Lightbox, and those were all up in January and February. And now we've got the macro backdrop, which is shifting pretty quickly, as we just covered. But It's interesting. It was April last year. We saw a very short-lived pivot as the tariff war started, and the market just kind of, to use the term that we used last year a lot, the market just kind of soldiered on. And here we are, a year later with a different kind of upset, wondering if the same thing will happen and the market will just kind of absorb it and adjust? Or do these early cracks that we talked about start to widen into something more widespread and systemic? I tend to agree with you, not to be gloom and doom, but I just think the impact of higher oil prices combined with a jobs market that was already weakening and what we talked about in the equities market, there's a whole confluence of factors that I think could work against the momentum in commercial real estate. So we definitely have a lot to watch in the coming weeks and months.
I want to get into the gating thing in a moment, but I do want to close out this particular segment with final thoughts on the CRE market and whether it will soldier on or not soldier on. My gut right now is that this will be different than April. I do think that it took a long time in 2023 and 2024 for buyers and sellers to meet equilibrium. We saw that shock in interest rates, property valuations tumbled, would-be sellers held out for higher prices, the prices that they saw in 2022, and buyers were not willing to meet them there because cost of funding was considerably higher than it was 2 or 3 years earlier. And I do think we'll see this on at least a mini level in the short term. I do think that would-be buyers are saying to themselves, look, my cost of funding is now 75 basis points higher than it was a couple of weeks ago. Yes, I had a firm price in mind, but that price is now lower. And I can see buyers pulling in their horns, to use your term, and sellers saying, look, this is a temporary blip. We're holding our price firm. And when buyers and sellers diverge, you do see that slowing down of economic velocity in CRE. So I do think that this may be different than what we saw in April. Let's hope not. Let's hope that people see this as a temporary condition and that the war will be over shortly. Oil prices will be back to $70 by Memorial Day, and this will be short-lived, as you said. We can only keep our fingers crossed.
Yeah, and it could go in a lot of different directions. And I think the biggest unknown is how long oil prices stay so high. And that's really, I think, the linchpin for everything else that kind of flows from it. But those are all good points that you made. The reality is there is a lot of capital looking for a home in the U.S. commercial real estate market. But as we mentioned right at the start of this, borrowing costs have changed in a very real way in a very short period of time. And our market hates volatility. So let's hope that the dust kind of settles quickly and we get back to what we saw in January and February, which were very strong transactions.
Let's turn our attention to the gating for a moment. I put out a research piece about a week ago. You could find it on the Lightbox LinkedIn page. And the headline was something to the effect of, thank goodness for gating. And I agree with you that when you see somebody gating, and this is not the first time, let's remember, we saw BREIT gate a couple of years ago when people wanted to pull their money out of their REIT when interest rates were rising. We saw Starwood gate a couple of years ago. Now we're seeing it from Blue Owl and others on the PE side. And I do agree that if you are an owner of these funds, you're miserable. You are promised a liquid vehicle. You want your money back. You're worried about losses, and you're eager to redeploy that capital. And you're being told, we're only going to give you 10% of your desired redemption because we are gating. And if I were invested in those funds, I probably would be annoyed no end. But I look at the gating at a broader level in the same way as I saw the Fed's actions last May, or I should say a couple of Mays ago, when Silicon Valley Bank was failing. We thought Silicon Valley Bank failing was going to be the first of many banks to fail. Their failure was because they had bought a lot of long-duration CMBS. Those values of their CMBS holdings were plunging due to higher interest rates. That led to a run on the bank. And it ended when the Fed basically came in and said, we will now start taking CMBS collateral and allow it to be pledged at par, so you don't have to take market losses. And even though they didn't say it out loud, the assumption was that they were going to insure deposits up to $1 million. And that put an end to this doom loop that Silicon Valley Bank was. I do think the gating prevents a doom loop. If there wasn't the gating, that 10% redemption requests would become 20, would become 30, would become 50, and Blue Owl, BlackRock, Blackstone, KKR, Carlyle would have to sell en masse, flooding the market with these loans, and the marks would turn incredibly ugly. We would see a sell-off like we've never seen before, and then the systemic risk would be real. The gating prevents this from happening, and as I said in that write-up, we should thank our lucky stars that they have to gate or they can gate.
I love these little historic side journeys that you take, Manus. They're so interesting, and you highlight the lessons that were learned in the past. And while gating raises the red flags that we've already talked about, we should also be grateful because it's a safety net. But there are obviously ripple effects in terms of valuations if we see these massive sell-offs of assets. But when you start seeing headlines about gating and then a few do it and the rest think, well, gosh, we better set those up too and put these protective gates around our assets to protect ourselves, then collectively that starts happening and everybody kind of retreats to the sidelines until things settle down again.
You got to be careful, Dianne, where you flatter me about historical stories. It won't be too long before I'm talking about riding my two-wheeler to 7-Eleven to get a cherry Slurpee after Little League. I could easily spin off the rails and talk about things like that for 3 hours, as my wife sadly knows.
That's why people love you, Manus. You're a great storyteller.
Okay, let's turn to our Lightbox data dive. Dianne, what are you watching this week?
So anybody listening to the pod regularly knows that the data types that we typically aggregate for the monthly CRE activity index are appraisals, phase 1 environmental site assessments, and property listings. And when I think about those three, I view the property listings as kind of the tip of the sword. If properties are going on the selling block, then that's turning the engines for commercial real estate. And if they're not, then it's a sign that that flywheel is starting to slow. So for this week's data dive, I went back to February and I looked at how the property listings coming onto the market played out week by week. We did have a very, very strong jump as a whole in January and then another one in February. But week by week, we saw a 15% spike in the first week of February. There was a brief dip the second and third week, and then it finished the month strong with a 13% surge in listings over the prior week. So we did see a very strong month-end push for property listings. Then, of course, the airstrikes in Iran started on the very last day of February. So in a week and a half, believe it or not, it'll be April, and I'll have the same weekly stats that give us a play-by-play for March. So we'll see how that particular data point played out in, as we just talked about, in a pretty volatile month.
I think these next 2 months are going to be very important for that index. I've touted this since the very beginning, since the mod squad, let's call it, of Dianne, Nathan, and Quinn within Lightbox, who assemble all this data, started putting this out a couple of years ago, that many market watchers, many analysts look at things like call reports from banks to see what capital flows look like. Who's lending? What are they lending into? Are they growing their book? How quickly are they growing their book? Are they doing it in the C&I space or in the CRE bucket? But that's a lagging indicator. That comes out 45 days after the end of the quarter, and the quarter itself spans 90 days. What we're really looking at with these appraisals, these due diligence reports, and these listings is really where rubber meets the road week after week. And I do think that if we're going to start seeing a slowdown based on the war and based on the PE woes, that's going to start showing up to some degree in the March numbers and probably more significantly in the April numbers. This really is a forward-looking device. And if we're going to have problems in CRE, Diane's going to be the first to know.
And for this week's Did You Know, I hear you've got something tied to March Madness. What are you seeing, Dianne?
I do, Alyssa. Like you, Manus, I love March Madness. We're preparing something fun around the NCAA predictions using Lightbox data. More on that next week, but for this week's Did You Know, I took a look at the cities driving the strongest demand for environmental due diligence last month. And if I were basing my brackets just on that, I would have Houston, which was up 28%, Atlanta up 27%, and Tampa up 23%. I will say that my home state team, Go Yukon Huskies, if I used Hartford as the nearest MSA, wasn't too shabby. They had 14% growth. So did you do your brackets, Manus?
I certainly did. And for me, the yin and the yang is always, do you go with your heart or do you go with your wallet? And I've been a lifelong St. John's fan, big rivals of your team, Yukon, of course. And I've been going to games for, I don't know, since before there was television practically, with my dad, who was an alumni of St. John's. So it runs through my blood. And very few people are picking them to win it all, but you have to go with your heart when you have it running through your blood like my family does. You have to be pulling for St. John's with all your heart. So that's where my eyes will be this week. They open up in San Diego. And having taught at Clemson for one semester and having a couple of kids go to Clemson, they too are in the tournament. Not a big favorite, but they're playing down in Tampa. So I will have eyes on them as well and rooting for the Tigers very hard.
Now let's jump into the deals that caught your attention this week. Manus, why don't you kick us off with development?
I feel like I have to start here because the podcast has been full of doom and gloom at the high level. So I wanted to start with something that was positive. In Santa Clara, an apartment complex landed a $150 million construction loan from Bank of America. This is a story from The Real Deal. Why am I bringing this up? The first thing to disappear during periods of illiquidity are loans on construction and conversion. Those are the trickiest projects to execute. The Real Deal notes in the article that multifamily development has been down in Silicon Valley due to high building costs and tariffs, and yet Bank of America still thought this was a worthy credit to put $150 million into deployment for this particular project. So I wanted to start with a happy one that the lending spigots for now remain open. And in this case, a multifamily project in Santa Clara is coming.
Yeah, at first read, Manus, that one made me wrinkle my brow a little bit just because multifamily development in that market has really slowed down for the reasons that you mentioned, and here's a $150 million construction loan. But it tells you they're playing the long game. I think they're probably betting on tech-driven demand, and nothing says confidence like getting those cranes out, right?
Absolutely.
While development is facing headwinds from rising costs and tariffs, retail is telling a very different story on the investment side.
We've seen a couple of things recently that kind of go against the grain on the retail, and I want to run through these quickly. The first one, Ben Ashkenazi sold the Beverly Connection Mall in California to medical provider Cedars-Sinai for $270 million. That comes out to almost $800 a square foot. Reporting there again by The Real Deal. Why bring this one up? A couple of reasons. Number one, we talked last week about a parcel in a mall in Queens selling to Northwell Health for $235 million. It was once an Alexander's store in Queens. Now that parcel will become medical office space. And here in California, we're seeing Cedars-Sinai come in, likely with the same strategy. Let's turn this property into a combination of medical offices, outpatient, lab space, along with things that lure people in, probably some restaurants, some apparel stores, things like that, a turning over of that property. So we love that. It's a high price and it's a likely redevelopment of that property. Lastly, we've talked about this before, I believe, Brookfield unloading Victoria Gardens in Rancho Cucamonga, also in California. We didn't have a price for this in the past, but now that price is out, $530 million. Redwood West and Panettone acquired that property from Brookfield for $530 million. That's just a hair shy of the whole all-time record in that market. A couple of years ago, the shops at Santa Anita in 2022 sold for $538 million. So the takeaway here, three big retail sales, all in the mall category, getting multiple $100 million price tags. We love that.
The Cedars-Sinai one was very interesting because although they haven't overtly said that they have plans to convert it or redevelop it, it's a critical piece of real estate. It's right next to their existing campus. And I think at a broader level, it's another sign that institutional buyers they're looking at retail not just through current fundamentals as a retail property, but also through the lens of what's a good future alternative use. And sometimes the highest and best use isn't going to be retail, which we're increasingly starting to see.
Okay, let's move from storefronts to warehouses. Industrial is telling a slightly different story right now.
So the first headline, Northbridge spending $82 million on an industrial campus in the Broward market. This is kind of the Miami, South Florida area. $82 million, not a price to sneeze at. So, we love high prices, right? It's a barometer for a strong market. But the subheadline that again came from The Real Deal, in this case citing Collier's data, says the Broward market for industrial has become soft. The county recorded 1.5 million square feet of negative absorption last year in the industrial space. And we've talked about this periodically, that it's really been a 10 or 11-year bull market for industrial as the demand for distribution centers and logistic properties has just surged due to e-commerce and other advancements in technology. And we always wonder if that trade will ever get tired. And here we have countervailing winds. On the one hand, Northridge paying a really high price, $82 million for this property. On the other hand, Collier's pointing out that for the first time that I can remember, sizable negative absorption in South Florida. So something to keep our eyes on. The other one, this one is out in Van Nuys, California, in LA County. Blackstone selling an industrial property there for $116 million, selling it via its subsidiary that does all their industrial buying and selling, Link Logistics. The headline there, Link Logistics, and we know it to be true, has been an active seller of industrial in the Inland Empire, Southern California markets for a while, and they continue to do so with this story.
Yeah, two interesting stories, Manus, from industrial. And, as we all know, industrial is going through this period as a whole of major stabilization after this huge wave of supply a few years ago. And, although it's been sitting at the top of the pile for many years, it's certainly not immune to that kind of softening. And I think the first story is an example of investors who are still buying, but there's kind of a realization that they can't just ride on rent growth anymore. And the Link's Logistics story, first of all, I have to give a quick mention to a loyal listener that we have at Link's Logistics. He heads up their environmental due diligence group. Hello to Neil Chandler, who tunes into our podcast every week. And, I think that story is also a good example of what's happening in industrial. You have a property where the fundamentals still look strong. It's 100% leased. And there's pretty tight vacancy in the San Fernando Valley, around 4%. But it's still the most supply-constrained infill market in the country. And I think that's why you see a deal like this for $116 million getting done. And then on the other side, you have Links selling these properties in what's more of a portfolio management move. So a lot happening in the industrial sector. These are two good deals.
All right, let's shift gears from industrial to leasing, where demand is picking up in a big way.
Two great stories from this week. One in New York, Bank of America expanding its footprint by 600,000 square feet at One Bryant Park. For those of you that don't know New York City real estate, Bryant Park is right near Grand Central Terminal in Midtown Manhattan, right near the New York City Public Library. A lot of this was developed about 15 years ago. Bank of America will be expanding from 1.8 million square feet up to 2.4 million square feet. So at a time where people are still worried about work from home, cities like New York, can they lure people back? Can they get people coming into the city 5 days a week? We have this terrific story of Bank of America increasing their footprint by a third. The other story in the leasing space, OpenAI surges past 1 million square feet of office space with a new Mission Bay lease. Again, really running the gamut here. This was once again the real deal with the reporting. ChatGPT giant is not only growing in Mission Bay, but they're growing throughout Silicon Valley. And we love that narrative of AI firms driving leasing, so far mostly in New York and San Francisco, but hopefully that spreads to Austin and the Research Triangle and Portland and Seattle and other tech-heavy markets.
Yeah, score another point for AI's green shoots and office leasing in San Francisco, which, as we all know, used to be the poster child for office vacancies post-COVID. And the Bank of America story is interesting, too. I walked right by there. I had the good fortune of visiting Lightbox's new office in New York City this week, which is beautiful. And it's also right by Bryant Park. But it's interesting, this is another big bank, Manus, that's kind of taking this flight to flagship theme and investing in corporate campus in a downtown location. We talked about JP Morgan with its new Park Avenue headquarters a few months ago, and now you have another big institution that's really doubling down on top tier New York City office. I love it.
Well, I'm always thinking about the little guy in New York City, that commercial real estate is an ecosystem. And while we applaud these huge leases for Bank of America and the return to office at JP Morgan, we love what that does in terms of trickle down, what it does for the guy who's selling the coffee on the street corner, the restaurants in the area, the sandwich shops and so forth, that so much of the ecosystem of the New York City economy permeates from how many people come into the city. And this is just win, win, win. And hopefully those street side guys that are serving the shaved lamb, see a bounce from the people coming back to office and Bank of America leaning in.
Yep. Indeed. It's a good point.
For this week's Slice of Life, we're revisiting a theme we've talked about before, the K-shaped economy. Lower-income consumers are continuing to pull back, and companies are starting to respond. McDonald's, for example, is rolling out a new $3 value menu. So, Dianne, Manus, what was your go-to order at the Golden Arches?
Well, McDonald's made two headlines in the past couple of weeks, both with the $3 value menu and that bizarre video with their CEO promoting their new burger, but referring to it as a product. So I'll tell you what my favorite product was when I was little. We weren't really a big McDonald's family, and I always hated that they put yellow mustard and pickles on their burgers, but their fries were a must-have, and you had to eat them hot out of the bag. So when we went, that was a really special treat.
I have to say, Dianne, the mustard on the burger really only is something you get when you get north of New Haven, Connecticut. I'm sure that New England had a lot going for it when you were growing up, but the mustard was not part of it. For me, it was always the fries. The fries were always the best part of the McDonald's experience. But I have to say, I'm a little bit annoyed at McDonald's these days because I am a big fan of the sweaty wax cup filled to the brim with ice and regular Coke. And they've replaced the sweaty wax cup with a plastic cup. And the soda is not the same in a plastic cup. Go back to the wax cup that we grew up with. The soda tastes better. It tastes better there. It tastes better at the ballpark. It tastes better everywhere, not in a plastic bottle, not in a plastic cup. Come on, McDonald's, fix this.
And with that, we'll close. Thank you to our producers at Bruning Media. Be sure to join us each week as we break down CRE news and data in context. You can listen on all your favorite podcast platforms and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening and have a great weekend.
Let's go.